think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This video today is brought to you by the Rule Symposium. The Rule Symposium is hosted by legendary natural resource investor Rick Rule. Be sure to click the link in the description to check out that event. It is from July 26th to the 29th, and I hope that you all get a lot of value out of it. He has a lot of key speakers coming, a lot of CEOs of mining companies, and brilliant minds within the natural resource investing space. So be sure to check that out. And today we got my good friend coming back on to the channel, Justin Huhn from the Uranium Insider. What's happening? How you doing?
I'm doing really well. Yeah. How about yourself, Daryl?
Oh man, I'm just chugging along, man. These markets, they beating us up, man.
It's a choppy market. It's very difficult to trade. Very difficult to trade. Yeah.
Yeah. I just recently did a video on the bear market rallies and being able to, like, right now I'm really like either holding dividend paying stocks, staying in cash, or I'm trading. So I'm kind of doing a mix of all three. Just because I'm like, yeah, there's no certainties right now.
Indeed. Yeah. It's a very interesting time in the markets. That's for sure.
Yeah. So, any updates on the uranium market? Any new developments that have been going on? I've been thinking about it a lot. I've been having a lot of conversations with friends about uranium lately, and talking about what this looks like in the future. And it's interesting just how like it's like a part of my belief system now. And so I'm like, actually, conversing with people, talking about like, oh, well, this is the cleanest form of energy per 100 kilowatts of power that has the less amount of mortalities and all of that. So I'm kind of getting into some of that stuff. But what's happening on the broader market space?
Yeah. Well, I'm trying to think of the last time we spoke. I think it's been 2 or maybe 3 months.
Yep. It's like February.
Yeah. So February. So that's 3 months. I guess, I mean, the biggest thing that happened is when we last spoke. Okay, I remember now. I remember we were about to interview in the evening of the Zaporizhzhia power plant attack in Ukraine. And I remember we rescheduled for the following week. And so that was kind of the first few weeks of the Russian invasion of Ukraine. And since then, that situation has only escalated. The fallout from that invasion and that conflict has continued to affect energy markets. It's continued to affect the uranium market. We have just really, really big moves across the fuel cycle since we last spoke. So we had a 50+% jump in conversion in March. We had a 50+% jump in enrichment in April. So the back end of the fuel cycle is moving up and moving up drastically. And the main reason for that is you have Western utilities seeking out Western supply of conversion enrichment, considering that Russia is such a big player in both of those markets. So that's probably the biggest thing that's been happening in the uranium market is we're seeing a tightening and an increase in demand in conversion and enrichment coming from the West. And that demand is going to Western sources of those two aspects of the fuel cycle. And the expectation of that is that will trickle down to the U3O8 market. And the reason for that is that we have conversion capacity slowly increasing. So with conversion, you can't really overfeed the conversion process as you can with enrichment. And I'll explain that in a second. But with conversion, you do have some players that can increase their capacity slightly in terms of producing more UF6 or converted uranium. And you also have the United States, the Converdyn Metropolis plant in Illinois is supposed to come back online next year. And that will add, 7 to 10,000 tons. And so that's a decent amount of capacity that's coming back. But the main thing that's happening is the overfeeding of the enrichment facilities. So in order to meet this increase in demand, the enrichers have to do two things. They have to raise the tails assays. So they have to raise the percentage of fissile U-235 that remains in the waste material from that process. So essentially they need more material coming into the centrifuges in order to produce more EUP at a faster rate out the tail end of that process. So that they need to overfeed the enrichment, the centrifuges. That means you need more UF6 coming in the front end of that process and more U3O8 at the very beginning of that process. And of course, invested in uranium, we're invested in the U3O8 miners. So that's how all of this affects us, really.
Yes, it sounds like things are picking up in terms of the West trying to become more energy independent. Would you say? And I know a lot, and I don't know how long this process takes, but I know especially when we're looking at like other energy sources, um, how they're trying to bring more production to either South America or back into the United States, and they're scrambling to try to figure this out. How long does this process take for? I mean, because I think Russia does what 40% of the enrichment or something like that.
Yeah, a little bit over 40% of enrichment, almost 40% of conversion. They are the biggest player in both markets. Well, the whole fuel cycle will last around 18 months from mined uranium to fabricated fuel. But the process of increased demand on enrichment trickling down to U3O8 happens faster than that. So we expect that pinch to come to the U3O8 market in a matter of months.
Okay, that makes a lot of sense. So we've been seeing a lot of volatility in the market. So kind of the first thing I want to chat about is how are you seeing monetary policy affect the price of uranium equities? I don't know how much it affects as far as like the spot price of the actual the metal itself, but I know that the I was looking at some of the charts with the Fed funds rate back in the 2000s when we had the last uranium bull market. It looked like when the Fed started raising interest rates, the uranium market started actually skyrocketing higher. And then when we had the bust in 2007, 2008, that's when we saw the market go down. Do you see any like correlation with like monetary policy and like, how the equities performed during that time?
That's a difficult question to answer. I think that the factors affecting the markets right now are actually pretty unique. I think that there's some past correlations. Certainly, you can look at history and find various elements of previous bear markets that correlated to kind of what we're seeing right now. I think probably the closest correlation would be the 2000 tech bubble, and then the Nasdaq bust. We've seen the Nasdaq have one of the worst starts to the year in history. Nasdaq was down about 30% year to date. It's bounced a little bit here. We've seen big name tech companies get absolutely eviscerated. Just the Netflixes, the Facebooks, the ARK ETF, things like this, snowflakes, they're all down just huge from their peaks in November, December. and that obviously affects all of these markets. So, since the last time we spoke, we also had the crypto market somewhat implode, pull back substantially, with a number of coins actually completely imploding. The Luna coin in particular wiped out $50 billion. One stat I've heard so far is that since the beginning of the year, there's been roughly $25 trillion of wealth that have been wiped out. So we've already had a big crash, but the unique element of this is the Fed's hawkish posture in terms of raising rates into what seems like a recession. So we're having, recessionary numbers start to come in terms of jobs, in terms of home building, in terms of, earnings from Target and Walmart, showing trends in purchasing shifting from discretionary purchases to necessities, things like that. These are all markers of recession. We're probably already in a recession, at least a mild one in the States. I think Europe's already in a recession. And so the Fed raising rates into a recession, I think, is really stupid, but that's what's happening. They should have been doing this during, boom times when we had, Trump in office, and that should have been a time to just start to gently raise rates. But, he obviously didn't do that. And so now we're in this unique situation where most markets are beholden to the moves of the broad market. Now there's been some exceptions to that. Oil's been incredibly strong. If you actually look at a chart of the uranium shares relative to the S&P, we've been outperforming since December of 2020 when the bull market really started in uranium. So generally speaking, we are seeing a decoupling of, let's say, value stocks and energy stocks from the broad markets, from growth and tech especially. Now, when there's a steep air pocket in the markets and we just have, a 5% down day in the S&P or in the NASDAQ, or even greater than that, as we did last month, that takes everything down with it. That's a liquidity crisis. Everybody sells what they own. And so there's no hiding from that. And the only way you hide from that is cash.
I thought you had somewhere we could hide, Justin.
Yeah. But you know what? I think your strategy of holding some cash and buying dividend paying stocks, and the more, the noisier that things have gotten over the past couple of months, the more I've been leaning towards just like zooming out and thinking long-term and looking out, okay, what do I want to own for this decade? And that's really helped to clear out a lot of the noise. And some of those names are uranium names. I think one of the, so just to wrap up that thought, when you have a liquidity crisis, uranium's going down with it, period. Just like everything else. When you have a weakening or a slowly softening broad market and improving fundamentals for uranium market, will outperform. And we're seeing that now. Since the bottom of that, I wish I could share my screen here. I don't know if you can enable that, but I can show you a chart if you wanted to. Yeah, we've seen, let me know when you're good. We've seen uranium outperform the broad market since that bottom, and it continues to do so, even though the broad market has been choppy. We've had a bit of a V-shaped recovery, but we're still chopping somewhat sideways. There we go. You can see that. All right, so this is URNM relative to the S&P. This is a basket of uranium miners compared to the S&P 500. So you can see, towards middle of May, when we really bottom out, we kind of made this undercut low compared to this trend line. And the interesting thing is that trend line, since the bull market began back in December of 2020, has marked an intra-cycle low for the uranium shares. But if you zoom out, let's actually go URA to the S&P, and we'll zoom out to weekly, and we'll see something similar. This trend line since the bottom. But if you look, relatively speaking, to how this has performed since its inception, by the way, URA launched just 4 or 5 months before Fukushima, so their timing was terrible. But then we were in a 10-year bear market. So now that we've turned around into the beginnings of a bull market, you can see just how unbelievably early we are in terms of decoupling from the broad market. And the trend is up. We have this 200-week moving average on this chart just now starting to tick up. I mean, that's how early we are in this trend. But overall, the uranium shares are in an outperformance trend of the broad market, and we expect that to continue for years, along with other energy names, metals, value stocks in general. And so the piece of all of that I think is most interesting is that nuclear energy and uranium, by default, has been sort of sneaking its way into the modern, tech parlance lately. So we've seen people like Chamath talk about nuclear on his podcast. He had, 3 other super techie Silicon Valley guys on his podcast. And the question at the end of the podcast was, well, what are you guys thinking about for this decade? What are you excited about? And all of them answered nuclear. And that's like, whoa, that's big. You have folks like Hugh Hendry, former hedge fund manager and super eclectic, brilliant, oddball dude. Recently on his podcast, he was asked, so what are you looking at? Where are you positioning right now? And he's like, well, I probably own a little bit of Bitcoin. I own some gold. I own some BHP, and I own some uranium. He's like, so it's the sentiment around nuclear being a theme for this decade is growing and it's getting embedded into just the investing, the value investing parlance of the day. That's really exciting, because I think when risk comes back on and we see money continue to rotate and start to pick up into value stocks, I think uranium is going to be a huge benefit factor of that, because of that growing sentiment for nuclear.
Yeah, that actually adds up a lot of what I've been processing through, and I did a recent video. We kind of just looked at I think it was the Wilshire growth to value ratio, and just showing like when growth outperforms, what is value doing, and then when value outperforms, what is growth doing, and so I think my audience has a good grip on like we are in this shift to a value oriented environment, especially the commodities bull market and such. And so that makes a lot of sense that sentiment is also changing with that, because commodities have been ignored for a long time, under invested in, or whatnot. And so now that more capital is going there, it's on the front screen, especially with inflation. I mean, inflation is a big topic, but what the things that are most inflating are the commodity prices. And so just looking at that, like I can see how that sentiment and that focus is changing in a broader sense.
Most definitely. Yeah, it's a super interesting time, because you have the sentiment is kind of juxtaposed. You have sentiment around the markets generally speaking, and doubt that the bottom is in, right? Like there's still, I mean, you're seeing SPUT, the Sprott Physical Uranium Trust, trading right around NAV for the past week and a half. They've actually been quietly raising cash. They're sitting on almost $100 million right now. They have yet to deploy that. And so in the past, before we were in a risk off environment, anytime SPUT corrected and came back up to trading near NAV, you saw capital come back in and push that thing to that premium, knowing they'd be raising cash and buying pounds. That volume's not there right now. The volume across the space is very, very low, but the sellers seem to be exhausted. So we've been just climbing this low volume wall of worry for the past 2 weeks. So you have sentiment around markets and investing space in general pretty low, but you also have this growing positive sentiment around the space, and kind of this expectation that, okay, when this is on, it is on, and it's going to be time to run. So it's the original investing thesis for uranium was very, very boring and kind of static, just looking at this supply and demand numbers, looking, the nuclear utilities are going to have to sign long-term contracts again in volume. The price is well below the marginal cost of production. It's a growth sector, et cetera, et cetera. That was kind of the 2017, 2018 sort of thesis. In the past couple of years, it's become, oh man, nuclear is kind of the future, and SMRs are the future. And there's a lot of excitement and a lot of hope and a lot of positive, just positive sentiment around the sector going forward. So it could be a very, very strong, longer bull market rather than a short speculative spike. That's of course something I would enjoy much more. So it's an interesting time to be invested in the space.
Yeah, for sure. I've actually, I kind of changed my strategy a little bit. I was in a lot of individual uranium companies, and I actually started reducing that, and then mostly going into URNM and a select few. I think I'm in Uranium Royalty, and I think a couple others. But I started reducing that, and a lot of what I was thinking about was URNM pays a pretty good solid dividend, as well as seeing that Sprott is the biggest shareholder of URNM, and then it also gives me exposure to Kazatomprom, and I think China General Nuclear is in there as well. And so just looking at like, okay, well, I don't know how to open a brokerage in the London Stock Exchange, when Rick Rule talks about that. So that's like a whole nother process that I ain't even dove into. But just looking at the simplicity of owning URNM to get exposure to a lot of these other companies has been very helpful for me.
Definitely. Yeah. That's not a bad way to do it. I mean, if you want exposure to a sector without taking on the individual miner risk, then, this sector, the way to do it is through SPUT and through the ETFs. You can have more leverage to the upside and to the downside by owning individual names. Last year we outperformed URNM pretty significantly. We did, I think, 122% in 2021, and URNM did 70 something percent. So we outperformed pretty greatly. But URNM has liquidity and has really good liquidity, and it's just an easy basket of stocks. So there's nothing wrong with doing that. If you can drill down on some names that will give you more leverage than just owning the ETF, you can get greater upside, but nothing wrong with taking a lower risk bet.
Yeah, for sure. And I think my bet is it's lower risk, but it was also like, okay, well, I'm thinking about, okay, I think Sprott tried to, I don't know, did the NASDAQ whole thing get declined or something like that?
Yeah, the New York Stock Exchange listing was denied. Sprott did actually take over URNM, so that's now the Sprott Uranium Miners ETF. But their application for the NYSE was denied, essentially because in the NYSE or the SEC, excuse me. So the NYSE accepted it, and they actually sent the application to the SEC on Sprott's behalf. That's the way it works. So the SEC denied it because what the NYSE did was essentially request an exemption from having to have redemptions in the trust. So in order to have, according to the SEC, in order to have a physical commodities trust or fund on the exchange, you would have to have a redemption mechanism where the shareholders could exchange their shares for the physical thing that the trust holds, and that obviously wouldn't work for uranium. So it was a quick no for them, and that obviously that helped to add to a negative sentiment right when there was risk coming off in the markets, which in my opinion, led to some of the harsh downside that we saw in uranium during that period of time, during early May especially. But in hindsight, I honestly think it's better for the investment case in the long term, because first of all, institutions are not having a problem finding the thing on the TSX. So I mean, they've raised $800 million this year alone. And they've raised almost nothing over the past 6 weeks. So when the money is flowing, they can find the TSX. Now, obviously, the NYSE would have offered far greater liquidity and much greater money flow, so it would have had more of an effect. But at the same time, if you prefer this investment to be a longer term super cycle, let's say, then I think that them not getting the NYSE listing is a positive thing. It's much more likely that if they had received that listing, that we could have seen, a 12 to 18 month just crazy price spike in uranium, and then, trade over. And, while that's exciting from a speculation and trading perspective, it's not really the type of investing that personally suits me. I'm much more patient with holding things for the longer term. So I think in hindsight, it's actually probably a good thing for the sector. And it's definitely a good thing for the nuclear energy sector, because, certainly the utilities were probably lobbying to get that shut down as well.
Yeah. It's I mean, it's a value. There's something that's providing value. This isn't a meme stock, so you don't want to you don't want it to be treated that way, for sure. So yeah, so that's very interesting. You said that. Especially with URNM and kind of a way to reduce risk. Because I'm sure a lot of people that are into this kind of space, when you're looking at retirement portfolios or whatnot, they may want to be in like the less risky ones. So they may go towards the ETFs or whatnot. But for me, like, I have a couple of individual names. I was just getting to the point where I had too many, and I was like, okay, I need to kind of reduce this and just focus on like a few of them. And so that was kind of like my idea behind it. And then, just looking at URNM, paying a solid dividend as well. And we're in this turbulent, markets or whatnot. So it's kind of like I don't
Yeah.
know. I'm trying to make sure I stay in the trade though. Because I believe in it, and it's something that I'm sharing with a lot of my friends and such as well.
Yeah, there's nothing wrong with that. And like I said, it is the safer play, but it's still uranium. So, you're still going to have, it punches above its weight regardless. So yeah, I'm sure that the ETF will still give you an exciting
Yeah,
run.
yeah. I'm surprised. Well, not surprised. I can see how the SEC denied the listing, because you have to be able to have that redemption of physical uranium, which people don't want in their homes or whatnot. And then
Yeah.
but I was thinking about that when you said that. I'm thinking about like the SLV and the GLD and all of that, and it's like all this paper gold, like you can't even redeem you can't even redeem, but the SEC is just approving them. So it was pretty interesting.
Yeah. Yeah. The Sprott vehicles, they're silver, gold, and platinum, palladium trusts that are listed on the NYC do have redemption mechanisms. So you can exchange your shares for the actual physical metal.
Yeah, and they actually hold.
But obviously that wouldn't work for uranium. You're not gonna have a can of it sitting in your garage.
Yep, for sure,
Yeah.
for sure. So, how important would you say liquidity is during these times? I mean, obviously, we're seeing this month. I'm expecting some uh, some bearish sentiment to really come in and take over at some point. And I'm looking at factors like, okay, the Fed just started quantitative tightening. We got inflation numbers coming out, and gas prices have actually went up. Oil and gas have went up. So we'll see how that impacts the inflation numbers. You also have the FOMC meeting, and the Fed's talking about raising rates by 50 basis points this month and another 50 basis points next month. Biden met with Jerome Powell, and they're like really focused on fighting inflation. So I'm expecting a lot more hawkishness this month that may um, translate into the markets. I know it's for sure going to translate into the growth sector for sure. And so I'm wondering if the commodity markets will be impacted, because like, I'm seeing oil's actually holding up really good. Like my portfolio is not really down that much because I held commodities or whatnot, and oil is actually going up and staying pretty stable. And so, what's your take on the sentiment that may be happening this month with all those different factors, and then how important is liquidity?
Liquidity is obviously important, most important when it comes time to take money off the table. So if you're trying to trade in and out of these markets, I would say it's very important. It also, it depends. It's a individual thing as well. Big funds need the most liquidity. If your position sizing is smaller, the amount of money that you have invested, you need less liquidity, but still clearly it's important. I think that's why some of these smaller names in the resource space move so drastically to the upside and the downside, is the liquidity is minimal. As far as predicting, the short term, it's really, really difficult. I'm with you. I don't think we're out of the woods. I don't think the broad markets have printed a bottom here. I think that we're going to see increasing in recessionary numbers. I do think inflation is likely peaked or is close to peaking. I think that there's a number of elements across multiple sectors that are showing that inflation is likely peaked. But like you mentioned, oil prices have gone up since the last numbers came out. So maybe we'll have a flat-ish CPI print. Maybe it'll be slightly down, but I think, I don't think the inflation is going to stay this high for that much longer, especially if they continue to hike, and we do see a more significant recession. We should see those inflation numbers come down pretty quickly, which would give the Fed an excuse to pull back. I don't think their intention is to fully crash the markets. Most people, especially those that are much smarter than I am, basically think the Fed's going to hike until they break something, and then they're going to pull back. So how soon that happens that's the bet that everybody's trying to make. And I'm just not really in that game. I'm trying to think about the end of the decade. Do I think we see some more downside in uranium? That's really tough. Yes, probably. When that happens, I don't know. And the only reason I say that is because I'm not seeing volume come in yet. But like I said, Sput's sitting on $93 million of cash that can buy 1 million pounds of uranium, plus at this stage, 1.5 million. And so, the spot price likely has bottomed. And so when will we see real volume come in? That's the question. It seems to me like that will happen when risk, generally speaking, is back on. And that seems to be the case across most markets. So my gun to my head, I think we'll see more downside in the broad markets, but I don't think we're going to see crazy downside and a huge crash and a deep depression. I think this is probably one of those things where there seems to be a lot of pent up demand, a lot of pent up energy. And so I think it's just a matter of the Fed doing what they need to do to bring inflation down to a level that they can live with, whether that's 4, 5, 6%. I don't know what it is. Maybe they just need to see, okay, what we're doing is working. Now we can pull back a little bit. At that point, like I said, 25 trillion is wiped out in 6 months, 5 months. So a lot of damage has already been done. We've got a midterm election year. I think that matters. I think that they're already facing a complete wipeout in the midterms, but I think crashing the markets is not going to help them. So they're trying to ride this knife edge between inflation and the health of the markets.
They said they want a soft landing, right?
Yeah, and I don't know how they pull that off. I mean, the only thing they can do to soften things, I think, is stick with what the market is. I think the market's pricing in another 250 basis point hikes, maybe 25 after that. So if they stick with that plan and it works and it brings inflation down, then possibly we see a little bit more downside the markets, and then they pivot, and then it's game on.
Okay. Yeah. That's a good thesis, and I like how you're keeping an open mind to it. You're not, like becoming concrete in this specific idea. This is definite. This is going to happen 100%. Like, it's. I mean, I've been seeing arguments on both sides. Arguments for a recession can be avoided. Arguments for a recession is going to happen. And so, I've been trying to stay as balanced as possible during this time, but also being cautious because we did see some big moves this year, just like you said, 25 trillion being wiped out. I've been staying away from the crypto market, averaging in a Bitcoin here and there, but I'm staying away from I actually sold all my altcoins in April, and I had an interview with a crypto specialist, and I told her, like, hey, I got out of altcoins, and then sure enough, 2-3 weeks later, it all went to shit. So
good timing, man. Good timing.
Yeah. So all right, Justin, well, plug the audience where they can connect with you at and everything, and so they can stay in touch and get, as well as get more information on Uranium Insider.
Sure. Yeah. We can be reached at uraniuminsider.com. We put out a very comprehensive monthly newsletter that's exclusive to Uranium. We do members only webinars that are 2 hours long. We do those once a month where we go super deep into the fundamentals, and we really focus on the fundamentals for the sector. In our opinion, having an understanding of this market is crucial because of the volatility. It's very, very easy to get shaken out. And that's how this market works. You'll see a couple of potential catalysts come in, and a lot of hot money comes in. They don't understand the sector and they leave. And that's why we see such volatility. And for us, we want to be positioned for the big run that, in our opinion, has yet to happen. I think we're still in the first couple of innings of this bull market. So that's what we focus on. We do it every day. We're deep into the sector, and we have a very strong team behind us. It's been a great experience so far. Like I said, we did really well last year. I mean, everybody did pretty well last year, but I was happy to see us outperform the ETFs. We're up about almost 400% since inception, which was August 2019. So we're coming up on our 3-year anniversary for the paid newsletter. And if you want to reach out to us, if your audience wants to reach out to us, we can send them a free sample of a previous month's letter. They can get an idea of the content we put out, and we can be reached at uraniuminsider.com.
Yeah. Thank you for plugging that. I just had a thought come to mind when you mentioned that, especially with the volatility and the importance of like subscribing to something like Uranium Insider, is that like you may experience, people may be able to stomach like one drop in uranium. I think it was when Cameco was at 32, then it dropped back down to like 19, and then it popped back up quite a bit, and someone could have probably survived that, but then they see it capping again. It really does something to you psychologically, where it's like, hey, like I may need to run for the hills or something.
Yeah, the markets can be very affecting. They really can be. I notice it. I mean, even I can stay pretty cool, and I keep my eyes on the long term, but I still feel it. I feel it in my body when when you see red across the screen. It's like, it isn't fun, but that's just the name of the game. It's what makes a market. There's always buyers, always sellers, and we just try to position to be on the right side of the trade for the long term. The short term mostly is noise for the most part.
Mm-hmm. Yeah. And how do you balance, like, as far as like, some people may be more inclined to sell if they have more than what they should be investing into the markets. So like, if someone's investing more than they should actually have in there, a high percentage of their net worth or whatever, then you may have too much money in the market if you're unable to like sit out and wait out the long-term thesis.
That's a really, really important question. I think if you're extremely stressed about your positions, you probably have too large of position sizes. Because of the volatility, we always recommend to people to make a rational allocation to this sector. Don't go all into uranium, because the volatility is so huge and it already punches above its weight. You have outsized leveraged without being overinvested or actually using leverage, borrowed funds and trading on leverage. So don't buy short dated out of the money calls. Don't, you just want to put, my friend Andrew Weekly, who runs the Smith Weekly service and podcast, he's very, very sharp when it comes to investing. And what he says about uranium is only invest what you're willing to lose. So I think that's a good place to start. And the more you understand it, you can maybe push that a bit. I have a pretty healthy allocation to the sector, but I feel like I understand it better than other sectors. So I'm very bullish on oil for the long term. I'm bullish on silver and gold. I'm bullish on copper. I understand them all much less than I understand uranium. So my allocation reflects that. And it's important to understand the sector, but you don't want to go all in on uranium. And when you do, if any of your listeners are new to this sector and interested in positioning, we've always recommended to do so across multiple tranches, especially right now. I would not go all in on anything right now. If you're just establishing positions, hold some cash, because the market might give you another opportunity. And with uranium, regardless of how great everything looks fundamentally, you'll almost always have a 25 to 45% pullback, once, maybe even twice a year. It just happens. That's what happens in these volatile sectors. So enter in tranches into positions and don't go nuts. Don't use leverage. Don't buy short dated calls. Don't have your position sizing too large. And if you're really stressed about the daily movements in your portfolio, your position sizes are too large, and you should probably have a decent percentage of cash in that portfolio just to soften the volatility.
Yeah, that's great advice. Great advice. Appreciate you for coming on, Justin, and giving that wisdom to the audience. Be sure to go check out the uraniuminsider.com. It's not in front of Uranium Insider. If you don't see it on the screen, be sure to check out uraniuminsider.com. I will leave the link in the description as well. Thank you, Justin, for spending your time with us today.
My pleasure, Daryl. Happy to be on with you again.